morning once again. Welcome to the Genghis Weekly Investor Briefing. My name is Daniel Ogeto from the Marketing Department at Genghis Capital. Once again, I'd like to welcome you to this webinar where we talk about all matters finance and what happened in the past week. We give a highlight of what happened in the past week in the financial sector and what to expect in this new week, that is in the fixed income and macroeconomics. Together with us, we have our head of research, that is Churchill Ogutu, flanked by Wesley Manambo and Melody Ndanu, both of them will be taking us through the presentation today. And we'll start with you, Churchill.
Thanks, Dan. Good morning to everyone. Let me share my screen. Give me a couple of seconds.
While you are preparing yourself, should you have any question, kindly direct them to the Q&A section and they'll be answered right after this presentation. Thank you very much. Over to you, Churchill.
Thanks, Dan. Good morning again. So as usual, I'll walk you through the macro and then I finish on the fixed income before my colleagues walk us through the equity segment. So matters macro, just a review of last week. As expected, we had the CBK, Monetary Policy Committee, retaining the CBR rate, central bank rate at 7%. That was widely expected by consensus. A couple of things came out from that MPC statement. One is issues to do with even the export. They noted that export during the first half period had grown by 11%. And on the other side, imports grew even further, faster at 22% year on year in the first half of the year. So that brought the current account deficit to 5.4% by the end of June. Obviously, a number of offsetting factors, things to do with diaspora remittance, which now reduced that trade imbalance or the trade imbalance between the export and the imports. Services, we still haven't seen much more uptick, just in light of the muted recovery in the different sectors, be it hospitality, be it aviation, which ideally are contributing factors to the services balance. But that said, overall, we had the current account deficit at 5.4%, though the policymakers expected to be at 5.2% by the end of this year. The other thing that caught our eye was on the private sector credit growth as at the end of June, and that was at 7.7%. That's the 12-month the private sector credit stock comparing to where it was a level 12 months ago. So the increase was 7.7%. And just drilling down into the specific review month, we saw that net private sector increased by 34 billion, which was quite impressive comparing to the previous months. We have been seeing amounts around 105 million that had been extended to the private sector. So that particular month of June, we saw at least green shoots of private sector credit extension. So that said, comparing with where the CBK usually puts out a monetary policy statement, just giving its outlook for the next 12 months where the private sector credit growth ideally will be. So the latest report that we saw, they were expecting private sector credit growth, particularly for this month, for June, to be at around 8.5%. That's the increase, but it was quite low at 7.7%. So it's still punching below its weight. But nonetheless, comparing or looking in light of the domestic borrowing, which is quite elevated, that it goes without saying that in the near term, private sector credit will still remain muted against the expectations. The other indicator or the other print that we saw towards the end of the week was the inflation for the month of July. Headline number was at 6.44%, slightly higher than the 6.3% in the month of June. And ideally, and what we've been talking about, the base effect, because the inflation print is comparing, say, the month of July 2021 versus July 2020. And last year, between April all the way to September, the inflation was coming down if you compare it on a month-on-month basis. So just based on that, the base effect kicking in, that implied that we could see some upward pressure in the inflation print between what has even played from May up until the number that we saw for July and all the way to September number. We still expect some upward bias in inflation. But having said that, drill down into the specifics, the effect of the excess duty on mobile usage from 15% to 20%. That had a knock on the headline inflation, in light that mobile airtime accounts for 5% of the overall consumer price index, CPI basket. So that is the single largest component in that basket. So with that knock, with the implementation of the excise duty that arose from the Finance Act 2021, that had a major impact on the overall headline inflation. Core inflation, this is stripping out fuel inflation and food inflation, that was still subdued at 2.9%, whereas food inflation went up slightly to 8.8%, but fuel inflation came down to 11.8%. The previous month, we were looking at 13.5%. It came down just obviously because of the what IPRA did mid-month. There was some, in as much as there was uptick in global prices, this fuel subsidy at least eased the pressure on fuel being experienced by customers. So that had an impact in fuel inflation coming down, north of 1.7% decline. So the other issue that came out last week was this publication of a white paper by the Central Bank of Kenya in terms of its monetary policy framework and also its operation. So a number of things is what they need to have as additional reforms. Just to take you back, some of the issues that CBK brought in this white paper is not that they'll be implemented from the publication of the letter of that white paper, but a number of things had already been started to be implemented. It's only that the white paper is just announcing some of the additional reforms. Right now, we are more or less, we started that transitioning from a monetary policy regime to an inflation policy regime, in the sense that the former was ideally looking at what is the monetary supply or what is the money supply in the economy. So that was the target that the CBK was focused on. But right now, in the regime that we are already in, partially, is looking at where these inflation expectations and what is the band that inflation should play around. And that band, we know that is between 5% plus or minus 2.5%. So the band is between 2.5% to 7.5%. So this white paper is just bringing on board some additional reforms that needs to be implemented to ensure that that monetary policy framework is more modernized. So the first one is in terms of diversifying or enhancing the forecasting and analytic tools. That is still work in progress, though there's a system that CBK uses. Its acronym is around FPAS, but they just want to ensure that it's more robust to capture the dynamics of the economy. The other issue is now strengthening the functioning of the interbank market, ideally by bringing on board what is called Central Securities Depository, whereby banks, instead of right now, what the CBK has decried is this fragmentation of the interbank market. You see, in any given day, if you get a drill down into the interbank market, you find that a bank is given at, say, a rate at 3%, and another bank is given at 6%. So that just points to the fragmentation of the interbank market. But with the central securities depository, the import of that is ensure that we won't see this wider divergence in the interbank market. So that is the goal for that. The other thing is now to bring a band between the CBR and also the interbank market, whereas when the CBR is, say, at 7%, the interbank market needs to play within a certain band. So that's another angle that they want to pursue. A number of countries such as Uganda, Ghana, and I think South Africa, they have that similar band. So that's what CBK wants to borrow from those other jurisdictions. The other two is in regards to transparency in loan price framework. This is now regarding issues to do with the risk-based pricing models. What we've been talking about, that the approvals or the request by banks was placed to the CBK, but we haven't seen much progress in terms of those models being approved. So, but from CBK's perspective, they want more transparency in terms of the loan pricing framework, but that issue is still open-ended. We don't have definite timelines as to when we could see an approval of the risk-based pricing models. Last one, enhancing monetary policy communication. So the other issue or calendar for this week, we're just expecting on Wednesday, the July Purchasing Managers Index, PMI. Ideally, the print is at neutral 50 mark. And then any number that is above 50 just shows that there's an expansion in business sentiment. A print below 50 just telling us that there's a bit of some contraction in business sentiment. And then there are a number of sub-indices surrounding the Purchasing Managers Index. So that's what we'll be keeping an eye on. Of course, we were a bit disappointed. We haven't seen the numbers in regards to the net revenue and expenditure as at the end of the last financial year, just to give us some more breadth, or just to give us how what was the overall performance in the course of the last financial year. So we expected that, we've been expecting that report to be published in the Kenya Gazette, but then last week we were a bit disappointed. So, but we'll just keep waiting up until it will be published in the Kenya Gazette, those numbers. And fixed income review. Last week, we saw an increase of in the order of 26% in the weekly turnover to 22.3 billion. The trades were focused on the short to medium part of the yield curve, basically due to the high liquidity that we've been seeing in the market. T-bills are still below the 24 billion that is being offered by the central bank. We saw an aggregate bids that were received at 17.8 billion. So that's represented 74% of the performance. 74% was the performance rate in last week's auction. That said, we saw 91-day, 182-day, a bit of some slight uptick in the yields, something in the order of 1 basis points, or rather 0.01% increase in the yield in the auction that was held last week as compared to the auction that was held in the previous week. 364-day is still up slightly above the CBR rate, 0.43% above that, but still at record lows. But our outlook in the fixed income report that we put out, we still expect that in the course of this month, we could see an uptick in the yield. So it's just a matter of time. As soon as liquidity normalizes, we could now see even having an impact in the T-bill yields. So in the next 2 or 3 auctions in our outlook, we expect that yields will be charting an uptrend rather than the downtrend that we've seen playing out since the month of May. Moving on to liquidity trends. Last week, interbank rates are still stable, just a decline of negative 0.09% to an average of 3.19% in the interbank market. OMO, that is the open market operations, whereby CBK comes and assesses the liquidity needs in any given day. So Monday throughout Thursday, CBK came in and mopped liquidity between Monday to Wednesday. On Thursday, they sat out of the market. they haven't updated us the results for Friday, but ideally we're looking at a mopping up of excess liquidity through an instrument that is called term auction deposits, the 7-day tenor. So for this, it works similar to what I mentioned earlier, something like a band, in the sense that for term auction deposit, the rate that banks bid is lower than the CBR, but if it's for a reverse repo, for a term auction deposits, the maximum bids that the maximum yield that banks should place is 7%, which is the CBR. But then for reverse repo, the minimum rate that banks bid if CBK is coming to inject liquidity is now the CBR rate. So the CBR acts like an anchor in the open market operation. But now the white paper now talks about the interbank rate needs to be, there should be a band around the CBR as compared to what is happening right now. The average for last week was 3.19%. So obviously you could see some bank bidding at say 1% because they are a tier 1 bank, and then another bank is getting it at 10%. But then if you do the weighted average rate, it's coming to 3.19%. So the thinking is there should be like a band. If CBR is 7%, we could perhaps see plus or 3 basis points, whereby the minimum should be around 4% and then the maximum around 10%, something like that, at least to ensure that there's some stability in the interbank market, which will have a positive knock towards lending. So that's the thinking behind that white paper. And as we try to bring it tied to the interbank development as at the end of last week. Net domestic borrowing for government securities. So far, our estimate is around 86 billion, inclusive of the overdraft facility. So that's around 13% of the overall target in this whole financial year, which is 58.5 billion. Last week, CBK announced the papers or the bonds for this month, which is featuring 3 bonds, reopening of 2 bonds. That's the FXD3 2019-10, the third 10-year paper that was issued in 2019. We have FXD1 2018-20, which is ideally the first 20-year paper that was issued in 2018. And then there's a new 20-year paper being issued this year, so FXD1 2021-20. Our target amount as per recent trends is 60 billion. For budgetary support, withholding tax for the 3 bonds is 10%. So looking at the stats for at least the bonds that are being reopened, the first one, FXD3 2019-10, it has right now its life to maturity, it's 8.1 years. That is still remaining. It has a coupon rate of 11.517%. So implied yield as at the end of last week was 11.99%. So the yield is higher than the coupon rate. So you can see the clean price is below 100. So for if you have 100,000 last week, so the clean price was 97,620. But you have to pay the accrued interest. This particular bond is issuing its semi-annual coupon. Bonds pay coupons every 6 months. So the next coupon payment is in 2 weeks away. So accrued interest, say you're buying it from somebody who has held it since he or she received the coupon close to 6 months ago. So the seller has accrued interest up until right now of, say, that's what you're talking about, something 11.517% divided by 2, and then just prorating it could be around something 5.5%. So that bit is what you pay to the seller, and hence the dirty price is just the difference between the clean price inclusive of the accrued interest. So if you want to get this bond in the secondary market, you end up paying 102,880. So the FXD1 2018-20 Right now, it has a life to maturity of 16.7 years, and it has a coupon rate of 13.2%. And since its yield is below the coupon, you find that its price is even the clean price is above 100. So for 100,000, you have to pay. It has 101,290 thereabouts. But then the accrued interest portion of that is around 5% for every 100. So you find that the dirty price is 106. So this is the statistics as of the end of last week in terms of the secondary market. But of course, now if we look at it, that because these bonds are now on the table for this month's auction, the pricing might change. And more likely than not, it could either be higher, the yield could be higher than the implied yield as at the end of last week. Recent trends tell us that that is what is the most probably to happen, or the yields will be lower than what is there as at the end of last week. So as you think about the bonds, this is the implied yields as at the end of last week. So this is basically acting as the anchor as to where the bids will be. In the event that the high liquidity that you've been seeing in the market, we could expect that even the yields at the auction, the results or bidding will come to slightly lower than where the indicative yields are, or the ground. If yields or if liquidity tightens a bit, you could see now yields go up slightly. But having said that, we'll put out a note for our expectations for investors sometime this week or next week with the Genghis Weekly report. Yes, the last paper is now the 20-year paper. Obviously, 10 years tenor. It doesn't have a coupon, but the coupon will be market determined at the auction. So that's we don't have something indicative around that. But just to compare what the 20-year yield is, I think is around 13% thereabout, more or less. Yeah. So finally, our week's trade, just a pivot away from the bonds that are on the auction, but ideally just looking at opportunities in the short end of the curve, short end of the yield curve. We have this FXB1 2013-15. It has a yield to maturity of around, its life to maturity is around 7 years. So that's a medium-term paper. And because of the high liquidity that we've been seeing, it has been a boost to short to medium papers. It has attractive entry levels in the sense that we're looking at its clean price. It's below 100. And then if you even add the accrued interest component of that is coming to 102 thereabout. So for every 100,000, you'll pay 102,000. So that's what's making it a bit attractive level. Though its next coupon payment will be similarly to the FXD3 2019-10, which will be 2 weeks away. So ideally, sometime this week is when you can look at positioning into this bond. Next week, at some point, I think on Friday, up until the other week, the bond will not be trading because of the coupon payment for the investors holding this bond. So let me stop there and invite my colleagues to take us through the equities.
Good morning to you. The market retreated during the week as signaled by the benchmark indices, Nairobi All Share Index and NSE 20 down by 80 and 40 basis points respectively. Activity in the week ended ended in a negative territory, posing a 7.9% week-on-week dip in turnover. The week's top gainers were Crown Paints, Yes Insurance, Kakuzi, and Can General, while Uchumi, Centum, and BV and Fahari Irate under spotting the week's laggards. It's quite in order spotting Centum in the laggards on the back of their released performance as we will cover in a few. Foreign investors exited across key stocks to clock net outflow position of 146 million, mostly bullish on Safaricom, EABL, and Stanchart, while accumulating on Equity and KCB Group. They accounted for 50% of the week's turnover. Centum released their full year results for the year ended 31st March 2021 on Tuesday. They reported a 109 year-on-year decline in the group's earnings per share from 10 shillings and 25 cents in the previous year to 90 cents loss per share in this year under review. The company's profit after tax improved from a loss of 3.4 billion to a loss of 600 million, attributed to in part by the impaired provision of assets in the investment portfolio. Operating profits also declined 75% year-on-year to 245 million on a 59% drop in investments income from 3.7 billion in the previous year to 1.5 billion. The company's comprehensive income declined also to 4.8 billion on account of a high rise in the unrealized gains in this current year to 4.2 billion. Also, the bulk of the 2.4 billion group loss was driven by the full consolidation of the Two Rivers Development Limited in line with the requirements of the IFRS, of which Centum only holds 58% stake in that joint venture. The counter's net asset value per share declined from 71 shillings and 29 cents to 62 shillings and 85 cents on account of the 606 million loss aforementioned. The board of directors have recommended a first and final dividend of 33 cents per share. The book closure and payment dates will be communicated to the market after the proposed dividend is approved in the next coming AGM. IGADS also released their results. They reported a 102.4% year-on-year rise in their earnings per share from a loss of 2 shillings and 7 cents to an EPS of 5 cents a share. Revenue grew 187% year-on-year to 139.7 million, while cost of production climbed 15% year-on-year to 85 million. Profit before tax for the period under review grew 106% to 4.7 million on the back of improved coffee prices and the revved up volumes due to the favorable weather experience in the year. The counter realized a revaluation gain of 176 million net of tax from its freehold lands, plant and machinery. This saw its balance sheet grow by 17.1% to 1.1 billion. The board did not recommend a dividend payment, and management maintains a bullish outlook on attractive coffee prices in the ongoing financial year due to the expected lower global volumes weighed down by Brazil's production. Also, the International Coffee Organization noted that June coffee prices recorded the 8th consecutive month of increase triggered by the aforementioned expectation of reduced supply from the reduced Brazil production. We closed the week with EABL results. That was on Friday, which was in tandem with Safaricom's AGM. The counter reported a 6.6% year-on-year growth in earnings per share, with revenues and cost of sales growing 14.6% and 15.6% year-on-year respectively. Profits before tax grew by 190 basis points. The slow growth was attributed to the impact of cost inflation, adverse foreign exchange impact, and tax changes. The counter registered a 12.9% year-on-year growth in its balance sheet to 100 billion. The rebound in net revenues in this year was on the back of the improved performance in Kenya and Uganda that reported a 10% and 33% year-on-year growth, and the sustained growth in Tanzania. Our outlook is that Tanzania will report sustained growth in the short and in the near and long term on the back of the revamped Serengeti brands and the new spirit line in Moshi. Also, the additional 30% stake in Serengeti's Breweries Limited places EABL at a better vantage point in realizing more revenues from this promising market. I think now their total stake in Serengeti Breweries Limited is about 71%. We remain cautiously optimistic on the gradual easing of containment measures, which will be a major boost to the on-trade such as Senator Keg. And in line with these sentiments, our trading idea for the week is a hold on equity with a target price of 198.16%, as we'll see shortly. To you, Melody.
Thank you, Wesley. So I'll take us through the Fahari iRate results. So it reported a 52.1 year-on-year decline in its half-year EPS from 0.48 in a similar period to 0.23. So the net profit that was generated during this period declined 50.9% to 42.2 million, which was attributed in part by the significant decrease in rental and rent-related income, driven by the loss of revenue from its anchor tenant, which was Tuskys at Greenspan Mall. Though now we've seen that they've announced that they're onboarding Naivas as a replacement anchor, which raises prospects that it will have improved performance in the second half. For interest income, it declined 9.6% to 11.8 million due to reduction in cash available for investment as a result of the previously mentioned loss of revenue from the anchor tenant that was Tuskys. For property expense, it increased 8.9% year-on-year, while fund operating expenses plateaued on a 2 basis point change. So the rise in property expense was attributed to more tenants withholding 10% tax on rent paid. The balance sheet grew 2.1% year-on-year to 3.8 billion on account of a 94.3 year-on-year rise in investment securities. So the rates manager did not recommend an interim distribution for the 6 month period ended 30th June 2021. So just a side note is that the Treasury has reversed its decision to charge VAT on asset transfers in rates and asset-backed securities in a bid to boost uptake of these securities. So the government had last year reinstated the VAT charge on the transfers in amendments to the VAT Act. Moving on to the performance of the NSE versus its peers. So the sentiments have been bearish on the week on the NSE market, declining 0.82%, though the year-to-date sentiment was positive at about 16.71% growth. So NSE's PE ratio stood at 13.9 times versus 11.1 African median, and the dividend yield stood at 2%, which is lower than the African market median of 5.2%. Moving on to the corporate calendar, we've seen BAT's book closure is going to be on the 12th of August for the interim dividend of 3 shillings and 50 cents. So moving on to the financial sector. So I'll be looking at like the banking and the insurance counters. So the banking sector counters witnessed rallies on their share prices, with most of the counters closing at a higher price as compared to the start of the week. Though Standard Chartered has been relatively flat at 129 shillings and 50 cents per share during the week. Stanbic closed at 38 shillings, above its 12-month high of 84 shillings. On the insurance sector end, Britam closed at 7.86, which was above its 12-month high of 7.78. CAC also rallied to close at 2.96 from an opening of 2.63 shillings per share. And also, Kenyaji has been seeing a slow but gradual uptick in its share price from 2.54 at the start of the week to 2.57 at the end. For Jubilee and Liberty Holdings, however, the share price declined 1.4% week on week and 4.4% week on week, respectively. So the Kenya Bankers Association released the State of the Banking Industry Report. So this is an annual report, an annual publication by the KBA that's aimed at contributing to the understanding of the Kenyan market. So according to the report, the banking industry is sound and stable despite the impact of the COVID pandemic. So it highlighted that the overall profitability and contributions to national budget declined to a 9-year low on the back of the COVID-19 impact on the economy, especially on sectors like trade, manufacturing, and agriculture, where banks restructured majority of the assets. So total assets expanded 12.4% in 2020 to 5.4 trillion, which was driven mainly due to a faster expansion in non-loan assets, which is government securities, which grew by around 18.5% year on year. So this was much higher than the growth of loans, which grew just by about 6.7%, mainly as the lenders took a cautious stand against lending. So the banking system deposits grew 13.1% up to close at 4.11 trillion, mainly because individuals and enterprises took flight to safety to banks to deposit their money there because of the highly uncertain environment. So because of this build-up being faster than the growth in loans, that led to a higher liquidity in the banking sector. In terms of capital adequacy, the ratio rose to 19%, up from 18.8% in 2019, which is above the minimum requirement of 14.5%. So this this was supported by an increase in total capital, which outpaced the growth in total risk-weighted assets. So we observed that in the first quarter of this year, most of the listed banks turned to borrowing from international institutions like Africa Development Bank, IFC, the Dutch bank, to not only strengthen their capital position, but also to boost the lending to the perceived riskier segment like the MSMEs. So asset quality across the sector declined in 2020, mainly due to the effects of the pandemic, as we said before, on households and enterprise earnings, which led to an increase in NPLs. So the gross non-performing loans ratio stood at 14.5%. Which was higher than the 12.5 that it had ended the year in 2019. So yes, so as per the last MPC statement, however, that's a Monetary Policy Committee, they say that the NPL ratio now stands at 14.0% in June compared to 14.2% in April. It's showing some slight improvement, but this is still higher than the pre-pandemic levels. In terms of provisioning, it increased 47.5% to 198.1 billion, mostly due to loan loss accommodations, as loans were not performing as they should have, as businesses were affected. So overall profitability, it fell 30.9% to 107.3 billion, which is quite low, lower than the levels since 2012. So the reason of this dip, mostly it's because of the elevated provisions and also the impact of the MPC, that's the monetary policy rate cut on the CBR, that's the central bank rate. So the report also states that it expects that credit growth will depend on some various factors. That's like how the asset quality is going to evolve during the year, and the balance between enterprises and household resources and government's resource needs on the other end. So that will be a factor. So because of this increased government lending, we're of the opinion that domestic lending may end up being crowded out in the short term because of they prefer to invest in risk-free assets than to invest in the perceived riskier private sector. So moving on to Home Africa's results. So the results had been delayed. The firm had requested for it to be pushed from 30th June. Now they just released it 31st July, as they were giving the auditors more time to finalize with their audit. So the company reported an 11.7% improvement in its loss per share to 0.6 loss from 0.68 in the previous year. It had experienced a 61.8% reduction in loss before tax to 338 million from 886.6 million in 2020. So the gross profit grew 1,344% from 3.6 million shillings to 52.4 million shillings in 2020, but mostly due to the reduced cost of sales. Revenue from its customers, however, dipped 25.9% to 269.1 million. Operating loss was sheltered by a 58.7 million fair gain on investment property, as well as an absence of 390.5 million impairment that was there the previous year on inventories. So in terms of the Miga golf course, which is a long-term project of the company, it's expected to realize profitability at the end of the project, which is about 3 to 4 years' time. So the firm also plans to invest in infrastructure on these various projects, especially in the Miga golf course estate, which aims to improve the market share so that the land bank, the land that they're holding, becomes more desirable. So as at the end of full year 2020, the value of the sellable land was about 3.6 billion. So the board has put in place a turnaround strategy that is looking into additional revenue streams to boost its top line revenue, generate liquidity, and also the completion of existing projects and reorganization of certain projects. So last year they had some salary and cost reductions that helped reduce their cost as well. We've seen that the total equity position is actually at negative 2.3 billion, mostly due to the sustained accumulated losses, which was 10% higher year on year from 2 billion in 2019. So the board of directors of the company did not recommend a dividend. So as a side note, there was an article that was published in the dailies May of this year, where it was accused, where the Miga Residents Association accused Home Africa and Sycamore Pine Limited of keeping them in the dark about a project that they had, an affordable housing program that they had with the government. So this association was stating that Home Africa and Sycamore sidelined them by conducting the environmental impact assessment and construction, and they have already broken ground despite their opposition. So it looks like this residents association is fearful that this construction will devalue the property of the homeowners of the Miga golf estate. So so the trade of the week, I think Wesley had taken us through it. It's EABL at a target price of 198.16, which is a hold. So that's the end from my end. Back to you, Daniel.
Thanks, Wesley and Melody. Let me just chime in before Dan takes over. In regards to a couple of announcements that have come in today morning regards a delay in publication. The first one is on Scan Group. there's an announcement delaying its publication for full year 2020 results. It was meant to have come in March, was extended till July, but now there's a further 1 month extension. So that's one. The other one is on NBV. I remember start of July, they came up with some corporate announcement that they want to acquire some companies. So based on that, they have requested for a further extension of delay publishing of its full year results year ending March 2021. So that's about it. Dan, over to you.
Okay, thank you very much, Churchill. There's one question here. Masibi is asking, IGAD made profits but did not give any dividends. Might you be knowing why?
That's a good question. Let me give my 2 cents thoughts on that. Yeah, well, the management did not give a statement behind the no dividend payment, but my view on the likely reason is to beef up the counter's retained earnings, as the sector is heavily dictated by the demand and supply dynamics and the exchange rates. And looking at this year, it has been quite favorable, but the company is trying as much as possible to invest so these retained earnings for future growth potential. So that's my thought behind the reason why they didn't give in, as much as they never stated the reason. Thank you.
Okay, thank you very much. Kamau is asking, besides Kenya Power, which other penny stocks have long-term growth prospects? Maybe Churchill, you can take that.
Well, that's a multi-billion-dollar question, to be honest. Just to look at where the companies are, you find that some of them either there's some issues surrounding corporate government, without naming any stock, by the way, or there are the industry that they are is quite not conducive. So just trying to come up with expectations of long-term growth is a bit hard. But I think by the next time we can be able to comprehensively answer Kamau. That, by the way, has caught us a bit flat-footed. And also the prospects, looking at the individual names that are paid by penny stocks. If I want to believe Kamau's question is stocks either that they are trading below a shilling or stocks that have drastically come down, depending on the definition of a penny stock. But I think like some of the names there, counters like Mumias or counters like Uchumi, which fundamentally I think their business or even their specific company-specific fundamentals are still quite weak. So at the moment, we can't really comprehensively say which penny stocks will now ride the storm and come out much, much better. Of course, there's a few names, unicorn such as NBV. This is Wesley's favorite stocks in parentheses, which have seen it skyrocket 1,700% return to its all-time high of 12.80 from 71 cents. So it's a bit hard to see these kind of stories within the stocks trading below a shilling, the penny stocks, that definition. So at the moment, I'll be a bit, and I'll do adjust to just pick a number or pick a name and say this is the one which has a longer term prospects.
Okay, thank you very much. Stephen Gasheru is asking, I have noticed that CIC has been a bit volatile for some time. Might you be knowing the reason behind this?
I can attempt this one. So for CIC, I think mostly it's just investors who are speculating on the price, though they had made some changes in their board around that around last month, where they were expecting that this will strengthen the overall governance and strategic leadership of the company. So it could be that these new appointments are breathing back new life into this insurer. So though the company hasn't really paid dividends for the last 2 years because of its performance, so it's just a wait and see to see how the company will do. But I think mostly it was that change in the board composition. So they're expecting that the strategy will generate more earnings for the company.
Okay, thank you very much, Melody. Rachel Karuri is asking, has Scan Group released its report for 2021? And is there any possibility of it going up to at least 18 shillings per share, that is?
Rachel, that is what I mentioned a couple of minutes ago, that they have put out an announcement that there will be a delay in its publication of its results. This is for full year 2020, which, if I take you back, around March or February, there was a suspension of their CEO and subsequently their CFO. So that has even led to a delay in publication of its, looking at the results and also the publication of its full year 2020 results. So they have asked for more additional time up until August for us to be able to get the full year 2020. So at this moment, we're still not even talking about its half year 2021 results. Up until we see full year 2020 is when now they can be able to do the full year 2020. Half year 2021. In regards to its pricing, it's a bit uncertain. One thing is big wildcard is what is these investigations that led to exit of their CEO or CFO. Is still a matter of conjecture in regards to the specifics. So up until the audit comes out or that particular investigations is when we can see exactly what's happening within Scan Group. But at the moment, we still haven't seen much in terms of being put out in the public regarding the investigation. So we won't even put a number that 18 will be the price that is it the number where Nini will go, where Scan Group will be at in the foreseeable future.
Churchill, I think I have a question in regards to the extension of, or rather, what is happening to Scan Group. Like, is there a limit to which companies listed in NSE can ask for extension of the time needed for them to present their results? For example, if it's half year or it's full year. Now that this is like the second time Scan Group is asking for an extension. And also, in addition to that, is this maybe does this affect investor confidence?
Yeah, you've brought out some valid questions, but I think the long and short of that answer is in regards to what is the specifics that has necessitated the delay in the publication of the results. If we look at a company like Transcentury, I think they were releasing their full year 2019 around June, or was it around May? So that was close to 1.5 years down the line is when they were releasing their full year 2019. But then they said that it's because issues to do with Tanzania. So that has necessitated the delay in publication. And even for full year 2020, for that specific counter, they have said that issues surrounding Tanzania is still at the core of the delay in publication. So it's just what justifies a delay in publication. If it's something that is more, it's justifiable, as we see in those counters, that kind of makes sense. So, but ideally, the exception is a delay in publication. The norm is usually that, if banks are supposed to publish at a certain time, or whichever listed counter they're supposed to publish at a certain time, they should publish at that particular time. But some counters, I think the last time we saw financials for Uchumi, I can't even remember. We haven't seen them publishing. I think the other 2 weeks ago in the Ugandan market, they suspended trading in Uchumi just because of some issues. They didn't get into the drill down. But first of it, looking at even what's happening in the Kenyan market, the delay in publication of the financials are not put out in public. It just leads to some erosion in confidence in the underlying listed counters. So that is a major issue. I'm not sure how CMA is tackling it, but I think that there's some ways that they're handling that particular issue with the delay in publication.
Interesting. So I think there being no other question, we'd like maybe to close it here. But before we close, we'd like to also remind you that, there's another question. Jafet Chilimo is asking, I'm seeing MMF performance has been going down from 9 to 8. Well, this one we will have to answer you through text or email as the AM department is completely different from the investment banking. So should you want to buy shares or sell, you can do it from your mobile phone. That is via our application called Jikuze. And our research department releases reports now and then. So you should be, if you've not subscribed to their newsletters, you can also send us a mail on info@genghis-capital.com. So there being no other question, I think we can close it here. Thank you very much, Churchill, Melody, and Wesley for your wisdom in this topics of finance, fixed income, macroeconomics, and equities. And we hope to see you next week. Okay, goodbye.